The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everybody in Europe. Good afternoon, everybody in China. You have just joined the USME Central webinar series, which we have every Tuesday from 5 to 6 European time, Chinese time, and from 10 to 11 European time. My name is Ludmila Hiklova, and I'm a legal market advisor here in the EU SME Center. Before we will go directly to our presentation, to our today's topic, I would like to introduce you a few functions of our webinar. First one is about the questions. During the course of the webinar, you can ask any questions which will be answered either during the webinar or at the end in the Q&A session. You can see on your panel, on your window, a small panel with the question application. Shortly about EU SME Center, for those who are for the first time joining our webinar. EU SME Center is a project which is fully funded by the European Union, and it was established in 2010 to support small and medium companies from Europe who wished to invest into China or export to China. We provide services which covers 4 areas. It's business development, legal and tax, standards and conformity, and HR advisory. About our services, you can see on the screen, we provide reply to the inquiries either via email or face-to-face consultation. We have a large database of publications, more than 80 publications covering different sectors and horizontal issues like taxes, how to establish a company, and so on. We provide trainings and webinars like this one. We participate in the events, and we provide to our clients free databases like database of exhibitions and international fairs, database of service providers, and recently launched law database. For those of you who wish to visit Beijing and have a business meetings or spend some time thinking whether it makes sense to establish a business in China, we offer a hot desking, so you can visit our center and spend some time with us. I mentioned that we provide support to small and medium-sized companies who wish to export to China, and I think that this topic very nicely fits to our services. We are receiving many questions from companies who are either export their products or provide services to the Chinese market. And main concern of those companies is usually firstly about buyers' financial credibility. As well, they are interested how to minimize risk of delayed or zero payments. And they are not familiar with local bank products and services. There is another problem when being paid from your export of goods or providing services, and it is that China exercises foreign exchange control, which delays most of the payment. And foreign companies very often don't have enough patience when they are waiting where will be paid. So for this topic, we have invited today a very experienced speaker. She is Mrs. Grace Yin. I will introduce her shortly before giving the floor to her. Mrs. Grace Yin is a senior manager and a tax and a business advisor and the Ernst & Young here in the Beijing. She started her tax career in Beijing in 2005 And before joining Ernst & Young, she worked for 4 years in the State Administration of Foreign Exchange, the famous SAFE. During her years in the SAFE, she focused on research and formulation of foreign exchange administration policies. And during her career, Mrs. Yin provided tax and business consultation to many multinational clients investing in China, including pre-investment structure consultation, drafting feasibility studies, tax planning, foreign exchange consultation, and so on. So I think this is enough for the introduction of our topic, and I will give the floor to our speaker, Mrs. Yin. Welcome.
Thanks, Ludmila, and I'm so honored to be here to discuss the topic of today. And so let's go to our agenda first. So today our topic will actually cover 3 parts. So the first one is the overview of the foreign exchange control in China, and the second one is we will discuss about the being paid for goods trade transactions, and thirdly we will discuss being paid for service transactions. So first topic is actually to introduce the overview of the foreign exchange control in China. So just as you see from the chart, so for foreign exchange control in China, it's actually divided into 2 parts. So the first one is current account, and the second one is the capital account. As you may know, the final goal of the foreign exchange control is no control at all. So that means the RMB can be fully converted. But currently, I just share you with some little important background here. So actually, China has officially accepted Article number 8 in the agreement of the International Monetary Fund in 1996, and the RMB at that time has already become freely convertible for current account transaction. So what means current account transaction is actually included trade and non-trade, i.e. the services. And you may see in the bottom below, the other part is actually the capital account. Capital account mainly included foreign investment. That means foreign investor make the direct investment to set up the company in China, and then to include to borrowing loans from overseas to Chinese company, and also including some capital market products, for example QFII and the QDII products, something like that. So actually under the current foreign exchange framework, the trade transaction and the non-trade transaction under the current account could be convertible freely. That means the SAFE not actually have some specific or some strict control on that transaction, but for the capital account it's still under the strict control. So our today's topic actually will focus on current account. You may see from this slides, I just include some basic principle of the foreign exchange administration on the current account. That will help you to have some better understanding about the total, the whole picture, and in that way you may get some general idea about how the SAFE and how the bank will involve in the foreign exchange control for trading activities. So first one is the goods trade transactions. So the general principle actually includes 3 points. The first one is generally the bank foreign exchange settlement system and the bank foreign exchange sale and the payment system will be used for the goods transaction. That means most of the transaction can be settled with the bank directly. No SAFE approval is required. So the second one is no restriction over the payment for trade transaction under the bank foreign exchange sale and the payment system. And the third one is the most important one, the generous examination by offsite supervision. So if you have the experience to doing trading business with the Chinese party, you may have the experience that the payment from China may be more and more faster, and that is because the safe actually involve less and less for the on-site supervision. So just in this year, the safe introduced some website system to control the transaction, and the safe and the bank can just have to share the data and the transaction information with each other. So that's provide a platform to the safe to do more and more offsite observation. But for the importer and the exporter of China, the Chinese companies still need to make a lot of reporting to that system. So the safe can do the offsite supervision based on the information provided from the banks and the enterprise as well. So the second part is about the service transaction. So again, the most important examination is the genuineness examination. So that means for the payment, for the services, the most important part is the bank will to examine the valid and sufficient supporting document. So if the supporting document can be provided to the bank, so the payment would be more smoothly. The second one is standardized of the control method. Again, as we just mentioned for the goods trade transaction, SAFE also developed a new system for the service transaction. So recently, they also launched a new regulation and a new system to simplify the payment method. So generally, the genuineness examination follows the common requirements of the foreign exchange control on the current account.
Thank you, Grace. And for this, before we move to a part of being paid for the goods and trade and transactions, I believe that we have a lot of already exporters of the goods or service providers, and we would like to know your opinion. So I will launch our first poll for today. And our first question is about your experience. Does your company face hurdles when getting payment for sales of goods or provision of services in provision services to China? And the first option is yes. The foreign exchange control rules in China makes us confused. Second option is no. The counterparties in China could help us to handle everything to get payment. And C, no transactions happen so far, but we wouldn't want to understand more about regulatory environment and practical issues when doing trading business in China. So I can see that vast majority of our listeners today belongs to the third group. No transactions happened so far, which is good, because then it shows that our webinar is right in the time. I will close the polls now and I'll share the results with you. So 6% of you do understand the control rules in China. Same 6% they have good experience with the Chinese partner, and the rest 88% they have no transaction so far, but would like to know more. So it's excellent. Let's go on. I give the word back to Grace.
Okay, so let's go to the second part. We will talking about being paid for goods trade transaction. So So for the first topic about goods importation, from the contractual arrangement perspective, you may see that's quite simple. The importer and the buyer and the seller just sign a contract. But in fact, the story may not so easy. So we just have a chart here. So typically, we have the foreign company as the seller, and we have a domestic buyer in China. So the first hurdle you may face is if the Chinese buyer does not have the import-export license. The background here is actually China still have the restriction on the importation. So the enterprise in China should have the license, and also for some certain products they need to have the import quota to do the importation. So the question is, if one foreign company would like to enter into a sales and a purchase agreement with the domestic buyer, but finally they just find the domestic buyer does not have the license or the quota, so how shall deal with that situation? Actually, if the Chinese buyer does not have the import-export license, it has to engage an import and export agent in China to do the to processing the import and export activity. So you will very care about how to sign the contracts between the three counterparty. So we have two options. So first one is the third party can have a three-party sales and purchase agreement. So on that agreement, typically we're including the certain criteria for the domestic buyer to get the product from the foreign company, and also to set up the obligation and the duty of the import and export agent. Just be careful on that. The actual buy and sell activity will happen between the foreign company and the domestic buyer in this contractual arrangement. But in practice, for importation declaration purpose, actually the customer declaration purpose and also the payment arrangement will go through the import and export agent here. So this is the first choice of the contractual arrangement. And the second one is you can just separate that agreement to different agreement. The first one is normally the foreign company can have a purchase order with the domestic buyer, and the second step is to the domestic buyer may engage the important agency and assign an importer agency agreement with the agent. And the third one is actually have an import agreement between the agent and the foreign company. So just separate that. So how to decide it? To choose which kind of contractual arrangement depends on the business requirements, and also depends on the bargaining power of the foreign company as well as the domestic buyer. In terms of payment, when the importation need to go through the agent, actually the domestic buyer need to pay RMB or the foreign currency to the agency first, and then the agency just pay the foreign currency to the foreign company. So that's actually typical arrangement when you need to use the import and export agent.
In this point, Grace, I have a question. What will happen? Just mention that I'm a foreign company and I found a domestic buyer, and then I find out that this domestic buyer does not have an import and export license. What is the usual practice? Who is the one who is normally looking for someone, for the importer agent? Is it a foreign company or is it a domestic buyer?
That is a very good question and a very practical question. Actually, the answer to that question is quite depends on the situation. So, to some example, normally the domestic buyer will identify and engage the import and export agent. For example, when a big domestic Chinese buyer, they have just have a big project and they need to procure a lot of different kind of machinery or equipment. Those of the machinery and equipment may be provided by different foreign companies. So in that case, if the domestic buyer do not have the import license, they would prefer to engage one import and the export agent to handle all the importation matter. Yeah. But in some case, the foreign company may have higher bargaining power. They want to control the channel, and they may identify their preferred import and export agent. Yeah.
Thank you.
Okay. So the next page, we're talking about the tax and the duties involved in when you import goods into China. So typically, the import into China generally will involve three types of taxes. The first one is customer duties, and the second one is the consumption tax, and the third one is the import value-added tax. So the customer duty and the import VAT are paid by the Chinese importer. One is perform customer declaration with the customer office when they import goods into China. So here we just use the wording importer, not just a buyer. So as we just mentioned in the last page, the buyer may not necessarily be the importer. So if you engage the import and export agent as the importer, so in that case, the agent will have the obligation to perform the customer duty and the import VAT filing. And but finally, the tax burden would be borne by the Chinese buyer, even though they just engage an agent in that case. And the other one need to mention is the consumption tax. So actually, the consumption tax is not levied on all the products to be imported. Consumption tax is actually imposed by the customer on certain luxury commercial products. For example, the luxury products such as the high-end watches, no renewable petroleum products such as diesel oil, and the high-energy consuming products such as passenger cars and motorcycles. So on this page, we just give a summary of the taxes and the fees may be imposed during the importation. So it actually provides some formula for the calculation. So you can see for the customer duty actually calculated with the CIF value and multiply the city right. Actually, currently in China, there are two main categories of customer duty rate based on the original of the imported goods. One is the MFN rate, and another one is a general rate. So MFN rate is more favorable in that case, but need to check whether the original of the imported goods, the jurisdiction can be adopted MFN rate. And also the customer duty may also be assessed as a specific rate based on the quantity or the net weight. But normally the first method will be preferred, and to be assessed as based on the quantity and the net weighted is only applicable for certain cases. For the consumption tax, import consumption tax actually will be collected either based on the volume or based on the quantity, with the tax rate and the amount varies very greatly. So we don't want to talk too much here. So you may just check the customer rate on this point. So the last one is the import VAT. So you can see that formula is quite complicated. Basically, actually, it's the CIF price plus the customer duty plus the consumption tax and then multiply with the tax rate. They generally have two tax rates. The first one is 17%, and the other one is 30% for agriculture products. So the imported VAT is actually creditable by the Chinese buyer or the Chinese importer against their output VAT. When the importer is the general VAT payer. So the tax rate will be adopted for import VAT will not be varied. Either the importer is general VAT payer or not. But when you negotiation the price, you may need to check whether the Chinese importer is a general VAT payer. So if the buyer is a general VAT payer, that means they can take the VAT import credit, so you may have more negotiate power on that point. And there is a note under the table, just like you to take care about that, is actually the import tax and the duty payable we just mentioned above should be calculated in RMB, and also using the benchmark exchange rate published by the PBOC. So we just talk about the calculation formulation on the last page. So you may have the question about how to evaluate the products being imported. So it's we just talk about the customer valuation and the customer duty calculation here again. So basically, the customer duty will be calculated based on the duty paying value. So the duty paying value basically is determined based on the transaction price of the goods. That's actually including the actual price directly and indirectly paid or payable by the domestic importer to the foreign seller. And again, maybe certain adjustment will be required here. And to make it simple, the duty paying value normally will include the transportation related expense and also the insurance premium on the goods before unloading at the place of arrival in China. So put it simple, that the duty paying value normally used for customer duty calculation is CIF price. So you may also find from the you may also see the form under the table in the left-hand side. The China Customer Office actually provide 6 valuation method applicable for customer valuation purpose. The 6 valuation method can only be used follow that consequence. So that means only when the method in the higher level cannot be used, the method in the lower level can be considered to be adopted.
And now, in the conclusion of this complicated topic of customs duties and customs tariffs and VAT tax, we will move to another topic, which will be about the payment. What are the payment options? But before we move to the next slide, we have prepared a second poll to ask you about your experience or probably preferred methods of being paid for providing for exporting of the goods. And our question is like this: when exporting goods to China or abroad, does not need to be only to China, which payment method you use or potentially would you use? It's a letter of credit, telegraphic transfer, bills of collection, or direct remittance. And I can see the votes coming. Yeah, that's interesting. That's interesting. Okay, so I am closing the polls. and we'll share the results with you. So 56, more than half of you would choose letter of credit, which is quite safe way. 22% are for telegraphic transfer, 11 bills of collection, and 11 direct remittance. So, Grace, what do you think about this? About these results? Maybe we can show the next slide, and then we will see what is less secure and more secure.
Yeah, actually the result of the survey just on the right hand side of our chart. So you can see the chart in this page actually talking about the payment method. So getting paid for the sold of goods is always critical for any business. So however, getting paid for an international transaction can be a very different experience from securing payment on business with the Chinese customer due to the number of etc. Factors that can influence the process. So the main factor in considering how an exporter is expected to be paid for a transaction is the potential risk that they and their customer are willing to face between them. So there are different type of risks that you will facing as a exporter under the following most popular payment method. We just list 4 method here. So as you can see in the left-hand side is just a direct remittance. This actually is the latest secure method of trading for the exporter, but maybe the most attractive way to the buyer. So that means the goods, as long as the goods was delivered to the buyer, the seller can get the payment. And in the right-hand side, the advance payment, that should be the most secure way for the exporter. Of course, that means you can just get pay first before you deliver any goods to the buyer. So in the next page, we just choose one of the payment method to have some detailed discussion about the procedure. I think maybe most of you has very familiar with that method, so we just quickly to go through that. The reason we choose the letter of credit is actually the letter of credit is a very typical way in international trade because the bank actually involved in that process to act as an interested party between the buyer and the seller. And also the letter of credit is a promise to pay. That means the banks issue letter of credit as a way to ensure the seller that they will get paid as long as they do what they have agreed to do. So we actually include 12 steps in the whole process to using the letter of credit. So first one, the importer go to the bank to apply the letter of credit, and the issuing bank just issue the letter of credit to the seller's advertising bank. So the advertising bank will forward the letter of credit to the seller, and the seller can at this moment to ship the goods to the appropriate port or the location as agreed. And then the seller present documentation to his advertising bank and also may provide a draft for payment. The next step is the advising bank forward the documentation to the importer's issuing bank. The issuing bank thereafter can notify the importer of the arrival of the document, and the importer will examine the documentation and to confirm the acceptance to the bank, and then prepare all the material for the payment. The next step is the issuing bank at this time can pay to the advertising bank. Advertising bank just to pay to the seller, and the importer authorize the issuing bank to debit its account for payment, and the issuing bank at this time to release all the documents to the importer. So the last step need to understand is after the goods actually arrived and the Chinese importer to completion all the customer declaration, the importer still need to report the import payment status under the letter of credit through the trading monitoring system of SAFE. So it may not be a time-consuming process for the importer to perform the payment status, but just bear in mind the Chinese importer will go through that step and have the record of their payment. And in this page, we actually list out some documents need to be provided to the bank for processing the payment. The two examples we mentioned here is just the most frequently used method just based on the result of the poll. It's quite similar. So the first one is letter of credit, and the other one is the trade prepayment by the TT. So we don't want to go through all the details. We list out all the document requirements here. It's just to give you an idea when the Chinese importer to effect their payment with the bank, they still need to prepare a lot of document, and it's a quite time-consuming process. So normally you will asking how soon or how long it will be take when I can get the payment for the importation or for the exportation. So the documentation checklist here is just give you some idea about the process and the timing. Okay, so now we just go to the last topic of today. Is talking about being paid for service transaction. So before we talking about detail, we may just introduce the concept of the providing services in China. So as we just mentioned in the very beginning, for foreign exchange control purpose, under the current account is including trade transaction and also the non-trade transaction. So when we're talking about providing services to China here, we just are talking about the non-trade transaction. That means all the transactions other than physical good transaction will belongs to the service. And not only for the foreign exchange purpose, we may just have some brief introduction about PRC taxes related to providing services to China. So for tax purpose, actually have two kind of tax need to be taken into consideration. First one is the corporate income tax. It's actually talking about the permanent establishment concept here. And the second one is the turnover tax. That means the business tax or the value-added tax. So normally the frequently asked question is, what if the service provided by the foreign company are totally provided abroad? So the question is related to corporate income tax as well as the turnover tax. But most of the question we focus on how about the turnover tax. Of course, before under the PRC BT or VAT regime is actually have the concept the business tax or the value-added tax will only be levied when the services are provided in China. But currently, under the prevailing business tax regulation, which is coming into effect on January 1st, 2009, business tax as well as the value-added tax will be chargeable on services where either the provider or the recipient of the services is located in China. So this change means radical departure from the traditional territory or place of supply concept governing the taxability of services to BT under the old law we just mentioned. So currently, Actually, the State Administration of Taxation, the Central Taxation Authority of China, just issued another circular. It's actually a circular 111. In that circular, actually provided some business tax exemption on certain services provided, which is wholly outside of China by the foreign provider to Chinese principal, which is also effective from the January 1st of 2009. So in that circular, it's actually including 30 type of exempted services that included culture and sports, entertainment, lounging, food and beverage catering, something like that. So basically, you can see that kind of services could be actually provided outside China totally. So the main principle is the service provider is located outside China, and actually the service also can be provided outside of China. So for that kind of services, that can apply to enjoy the business tax exemption.
Yeah. Thank you, Grace. Before we move forward to the registration and the tax clearance, you were mentioning a few times in connection with the services, the business tax is applicable. There were recently some changes, you mentioned it on the slides as well, that the business tax in some cases, in some sectors and activities was replaced by VAT. To which services this new VAT, it's not pilot, it was introduced to the whole China in August this year. To what services it is this new VAT applicable?
Yeah, as you just mentioned, it's quite strange in China. Of course, we both have the business tax and the value-added tax. So the government just launched a program to have some pilot program to gradually transfer the business tax services to be subject to value-added tax. So with the pilot program, the VAT reform program just come into effect on 13 September 2013. I mean this year. So for the nationwide, for certain selected modern services, typically it's actually the consulting services is currently subject to value-added tax instead of business tax.
Thank you. I have learned from my colleagues that we have today not very good connection, so for those who still can hear us, don't worry, we will have our webinar, we will put it on our website, so later on you can download it. But please, even so, do not hesitate and send us your question. We will address them at the end of the session.
Okay, thank you. So we just talking about the possible tax treatment in relation to provision services into China. So in these slides, we just introduce the registration and the tax clearance process before the service fee can be transferred outside of China. So we provide a flowchart here related to application of service contract registration and tax record filing process. So the first step is related to the Chinese service recipient. So when the service agreement was concluded, the Chinese service recipient is required to perform the service contract registration with its interstate tax bureau within 13 days. So after the contract has been registered, the Chinese service recipient will need to discuss with its interest tax bureau to determine the PRC tax treatment on the service contract. That's including the corporate income tax as well as the turnover tax. At this moment, so the Chinese service recipient will be engaged or may need to help the foreign company to check whether the overseas service provider is eligible for any preferential tax treatment under the double tax agreement. Typically, the royalty payment may be eligible for some preferential tax treatment. For example, typically the royalty payment under the domestic tax law is subject to 10% withholding income tax, but some double tax treaty may just provide the preferential treatment with 7% withholding tax rate. So based on the double tax treaty, if it is eligible, so the overseas service provider can just apply for the preferential tax treatment with the Inter-Tax Bureau of the service recipient. And after that, being the withholding agent, the Chinese service recipient will file the corporate income tax and the business tax or VAT tax return for each payment with its interstate tax bureau and the local tax bureau respectively, and then to settle the tax payment before the due date. As the next step, for remittance purpose, if the single payment amount exceed 50,000 US dollar, so the Chinese service recipient as the payer shall apply for the tax record filing. Is actually a kind of form with the in-charge tax bureau before they can process the payment with the bank. So we put two colors here. So just a new rule comes into effect on the 30th September of this year. There are two changes. The first one is actually based on that circular. The Chinese recipient is now required to perform the tax filing and makes the tax payment first before they apply for the tax record filing. That means when the Chinese service recipient makes a payment, they just need to have the contract to be registered and then apply for a tax record filing form. Then they present the contract together with the tax filing form to the bank. The bank should be fine to process the payment. But actually in the practice, we understand after the issuance of this new circular, in practice the tax authority may not so easy to just provide the tax record filing before the tax was paid. So in the middle, I mean the tax payment process and the tax filing process cannot be waived in the real practice. So it's not as expected. We just expected the new rule can just simplify the procedure and save time sometimes, but in practice it's not so good. So on the next page, we're just talking about something about the PRC tax withholding. So we put a case study here related to the technology services. So our example actually have a foreign company X transfer a technology to Chinese company for US dollar 1 million, and then the company X also will assign its employee some engineering for 3 months to China to provide some technical support services in related to the transfer technology, and the service fee is 100,000 US dollar. So during that case, some points we need to take into consideration. So first one is the PRC tax withholding obligation. We just talking about the tax burden maybe related to the providing services in China. But one issue is actually the obligation of withholding, which means which party will bear that tax. So normally one point maybe just the rules when you conclude the contract is the liability and the obligation to withholding the tax. So in the contractual arrangement, I mean when you conclude the contract, you need to discuss with the Chinese counterparty about the tax arrangement. That means which party will bear the tax. So normally we just saw some cases. They just put very simple wording there to see the Chinese party should bear all the taxes, or the payment getting by the foreign company will exclude any tax. But it doesn't matter to mean the Chinese company will bear all the tax. So the better way is just to put a price which is included tax, but that number actually being calculated under a gross up method. So that means all the tax has been considered during your negotiation. The second point need to take into consideration is the PRC withholding tax. Here we would like to talk about the withholding income tax. Of course, for the technology service, from PRC Tax Authority perspective, they may need to determine whether the fee paid for technology service is in royalty fee nature or in the technology service fee nature. As we just mentioned, if the fee paid for technology service is in royalty nature, it's actually a passive income from tax perspective. So it's typically will subject to the withholding income tax at 10%. But for the technology services, for income tax purpose, it is need to determine whether the foreign company has created a permanent establishment in China. So put it in simple way, if the foreign company just assign employees for the days less than 6 months or 183 days, normally the foreign company will not create a permanent establishment in China. So in that case, the technology service fee would not subject to corporate income tax China. So that's the reason the PRC Tax Authority would like to determine the nature of subsidy fee payment. One of the key points when the tax authority to determine the nature of the service fee payment is to see whether the technical support is an essential part for using the technology. As we put in the example, the company acts just assigned their engineers for providing technical support in relation to the transfer technology. So actually in that case, the result is the PRC Tax Authority determining the technology services is actually in the royalty fee nature and subject to the 10% withholding income tax. The last 2 points is also related to the technology service fee payment. One is the registration requirements. Of course, in China, for a Chinese company to import a technology is required to perform a registration for importation. They will give a certificate about the import technology and for remittance purpose before the registration with the government for importation of technology is required. But under the new rule, they just simplify documentation requirements. So currently for paying the technology service fee, is only required to provide the invoice and a contract to the bank to effect the payment. So the next topic we want to talk about is actually the settlement in RMB. It's a quite interesting topic and more frequently discussed during these couple of years. So in the left-hand side, the chart just give you some example. So when you considering about the settlement in RMB, maybe you will ask 4 questions. The first one is why we need to use the RMB. So the typical consideration for using RMB for settlement is mainly because want to minimize the exchange rate fluctuation risk here. So currently, under the current situation, the RMB is in the appreciation position. So normally for the import transaction, that means the Chinese company to import goods from overseas, the importer would like to pay foreign currency. And on the contrary, for the export transaction, when the Chinese company export goods to overseas, they may prefer to receive RMB. So that's maybe one of the reasons some of the export and the import transaction may using RMB for settlements purpose. The second question you may ask is how can a foreign company to obtain the RMB? So typically there are two ways. The first one is when the foreign company export goods to China, so they may get the payment from the Chinese counterparty in RMB. This is the first way, and alternatively, the foreign company actually is allowed to purchase RMB with overseas participating bank. The third question you may ask is how can a foreign company use the RMB received? So normally it actually depends on the your requirements or your business plan in the future. So if you have the plan to do the future settlement, that means you when you just import goods into China, you will also buy something from China. So normally when you receive the RMB, you may choose to open an RMB account in Chinese bank for future settlement. And alternatively, if you just have some one-off transaction, so you receive the RMB, you can receive that RMB by bank account open in overseas participating bank and then to convert into the foreign currency immediately. So the last question you may ask is actually the why the foreign company when the foreign company can open the bank account in China. The bank account open in China we're talking here is actually the RMB account. So before the foreign company receiving the RMB, you can just choose to open the RMB account either in the domestic agent bank in China or overseas participating bank overseas. And when you choose to open a bank account in the domestic agent bank, you may suggest it to check with the bank for the local practice. So that's all for my presentation today.
Thank you very much, Grace. It was quite a complicated topic, but don't worry. We will have all these slides on our website together with the recording, voice recording, so you can download it later on. And in addition to that, Grace drafted for us guideline. There is about 25 pages, a guideline on the same topic, how to be paid for the exporting goods and providing services, including foreign exchange control, banking products, and so on. So before concluding our today's webinar, a few takeaway points. For goods import, understand well contractual arrangement. Be informed that there is importer and that the importer can be different person from the real buyer. Be aware of tax withholding issues when providing services and include it into the contract. Check which category your importer belongs to. Perform preliminary due diligence on all your potential partners. And be interested whether your buyer can deduct import VAT that can significantly reduce your cost. Avoid less secure payment methods like direct remittance. Unfortunately, we will not have a Q&A session today. First, because we don't have time, but second, because today's connection is really very bad. So we hope that we covered all important topics in the webinar, and if you have any question, that you will find your answer in our guidelines, which will be published during the December. Please as well stay connected with us. Next Tuesday we will have, again at the same time, we will have another webinar. Please connect with us via email, visit our website, and you can as well use the social media. Thank you very much for your attention. Thank you very much to our today's speaker, Gracian. I hope that it's not the last time you are doing a presentation for us, and have a nice evening and a nice day.